Market overview: a highly turbulent wave of institutional selling swept across Wall Street today, bringing a decisive and bruising end to the market's recent multi-week upward momentum. The dominant market regime was aggressively dictated by sellers from the opening bell, as a major technological challenge from overseas collided with an intense options expiration Friday to trigger a wide-scale reduction in portfolio risk. The tech-heavy Nasdaq Composite bore the absolute brunt of this capital flight, plunging 1.4%, or 361.70 points, to finish the week at 25,520.24. Concurrently, the broad market S&P 500 surrendered 1.0% of its valuation weight to settle at 7,457.69, while the blue-chip Dow Jones Industrial Average shed 406.55 points, or 0.8%, closing the day out at 52,146.42. The primary catalyst driving today's panic stems from the artificial intelligence complex, where news of a highly advanced, low-cost open-weight AI model named Kimi K3, released by Chinese startup Moonshot, sent shockwaves through long-held market assumptions. Institutional allocators immediately began pricing in structural threats to the massive capital expenditure cycles of Western hyperscalers, sending the CBOE volatility index surging to a multi-week high above 19 as downside protection buying escalated rapidly. The concentration of wealth inside mega-cap artificial intelligence winners meant that as institutional exit doors narrowed, the downward pressure on individual chip makers was intense. Nvidia Corporation acted as the heaviest individual anchor on the benchmark indices, dropping 2.2% as large-scale fund managers aggressively locked in profits amid fears that voracious demand for high-end graphics processors might hit a near-term plateau. This selling pressure rippled violently across the semiconductor equipment and component ecosystem, causing Applied Materials to sink 5.6%. Concurrently, memory giant Micron Technology experienced massive algorithmic volatility, violently swinging between a 5.8% intraday loss and a 3.2% gain before ultimately drifting lower by 0.5% at the final closing bell. The technological anxieties were further compounded by a prominent sell-off in newly minted tech listings. Elon Musk's SpaceX, which recently debuted on the public markets, fell 5.4% to touch its lowest valuation since its highly anticipated listing a month ago, heavily weighed down by its exposure to the broader AI infrastructure theme and the high-profile rocket test flight abortion. Outside the hardware sector, the market's negative tone was deeply reinforced by high-profile corporate earnings disappointments, highlighting the immense fundamental pressure companies face to justify historically stretched valuation multiples. Streaming giant Netflix Inc. plunged 7.3% in heavy volume after its second quarter financial results flashed conflicting structural signals. While Netflix comfortably exceeded Wall Street expectations for net profit, its headline quarterly revenue fell just short of consensus estimates. More critically, institutional portfolio managers aggressively targeted the stock after its forward guidance for summer revenue and subscriber acquisition metrics landed below internal models, sparking near-term growth deceleration fears. Simultaneously, medical technology leader Intuitive Surgical suffered a severe operational blow, crashing 14.1%. Despite topping current quarter expectations, analysts triggered a massive liquidation wave by pointing to structural decelerations in robotic procedure growth rates, caused by the formal expiration of enhanced government tax credits that had previously lowered healthcare insurance acquisition costs. A meticulous breakdown of sector capital tracking showcases a dramatic flight out of expansionary growth products and a defensive migration into non-cyclical value blocks. Technology and consumer discretionary sat at the absolute bottom of the sector scoreboard, heavily dragged down by the synchronized correction across tech behemoths and digital media channels. This concentrated hardware evacuation registered heavily inside thematic index vehicles. The VanEck Semiconductor ETF, ticker SMH, closed deeply in negative territory, officially entering a localized technical correction from its recent all-time highs as massive fund flows exited its top component allocations. In contrast, non-tech heavy groups and value-centric industries showed significant relative protection. portfolios experienced selective inflows into defensive consumer groups, supported by a fresh macroeconomic report from the University of Michigan showing that U.S. consumer sentiment improved for a second consecutive month while near-term inflation expectations steadily cooled to a 4-month low. Heading into a highly anticipated macro trading week, institutional risk management requires a strict adherence to core technical levels and incoming fundamental catalysts. First, keep a direct technical focus on the S&P 500 as it rests near 7,457. Having surrendered its short-term upward channel, traders must monitor if the index can establish a firm consolidation base at the 7,400 technical handle or if further liquidation will force a test of its 100-day moving average. Second, the corporate watch list must prioritize upcoming earnings results from mega-cap heavyweights scheduled over the next 5 trading sessions. Investors will verify if corporate profit expansion is robust enough to absorb the market's current valuation multiple compression, while simultaneously tracking the stabilization of the 10-year U.S. Treasury yield near the 4.55% boundary. We advise maintaining a highly disciplined and balanced capital posture. While near-term spending anxieties are forcing a necessary and healthy cleansing of retail momentum clutter, the structural improvements in consumer sentiment indicate that the broader economic foundation remains exceptionally resilient. That concludes the U.S. market update. We will see you at Monday's opening bell.